This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. Today, our special guest is Daren Blomquist. Daren's focus is on analyzing and forecasting complex macro and microeconomic data trends within the real estate market and greater industry to help Auction.com build an increasingly efficient marketplace for distressed sellers and buyers. Prior to Auction.com, Daren served as vice president at Attom Data Solutions, where he was widely recognized as an authority in the housing and mortgage industries. Blomquist's reports have been cited by thousands of media outlets nationwide, including the Wall Street Journal, the New York Times, USA Today. Blomquist also serves as the executive editor of the Housing News Report, named Best Newsletter by the National Association of Real Estate Editors in 2015 and 2016. Daren, welcome.
Thanks, Bruce. Good to be here.
Good. We've talked quite a few times before, I believe, right?
Yes, sir.
Okay.
Yeah. And I remember when you first came in, back when it was Realty Track, when I was before Attom. Attom was previously called Realty Track, and I remember our executives brought you in. I think this was probably, it's hard to remember exactly when, but it was during or in the aftermath of the last recession, and brought you in for your insights on what you saw coming. And if I remember, you were pretty much spot on, as you usually are.
Yeah, nothing like putting things in writing, huh?
Well, this was just in a boardroom. We weren't recording, so there's no way to prove it either way. But
we had a 400-page report that said it was going to go in one way, and you put things in writing too, and you're kind of stuck. You're kind of stuck with it, and you get reminded pretty regularly if it's not right too.
That's right, and I've been on both sides of it, being right and being wrong, but. I know back then we didn't know what we didn't know, but we were collecting this pre-foreclosure data. This was around 2005, and we started seeing the numbers just spike. And so we said, let's put out a report on this. Nobody's talking about this, and the notice of default numbers and things like that. And I remember the Mortgage Bankers Association and others, not to pick on them, but they were very incredulous with our numbers, and in some ways, rightfully so. We were kind of new to the marketplace, but it turned out that there was something going on.
Yeah, it would be nice that when you came up with a scenario, it felt, and I did a lot of speaking at that time too. And everything was wonderful in real estate. And here you are talking about this isn't going to work out well. It was in everybody's interest to say, okay, well, let's take a look at what they're talking about and see if that's a possibility.
Yeah.
But things were so good that you just didn't even consider it. And that's why, you seem to be a fan of research and charts. And that's why I love that, because to me, it takes the emotion out of the equation. I could look at a trend and go, okay, look at that. When that happens, this next thing happens.
Yeah.
Now you graduated in 99, right? Yeah. In college. What was your attitude toward owning a house at that time? Was it an absolute, I've got to do it, or you already did it?
No, I don't think it was an absolute, but it was a strong proclivity to, this is the way to go. And I was in Illinois, in the Midwest, where I went to college, and we rented. I was a newspaper reporter, was my first job in the middle of Illinois, not making a ton of money, as you can imagine. But I remember we rented our first place there in the middle of Illinois. It was $500 a month for like a 2 to 3 bedroom house. Then we moved to California, where my wife is from, and that was 2001. And we bought our first house for, I think, $300, and we stayed in her with her parents for about 6 months to save up and start looking for houses.
Okay.
first house was 325,000, and I thought that was crazy as a Midwesterner. I thought why should we be paying this much for a house? But then we bought at the right time.
Yeah.
That was, we closed, I think, in January of 2020 or 2002, 20 years ago, our first house. Yeah.
How does that first cycle affect you when you look at 2020? So I always ask when people got started. So when I got started in 1980, interest rates were 17.5% and basically gone down for 40 years. And so when you came in, you were running into a 6-year cycle that was like boom crazy.
Mm-hmm.
So, and then all of a sudden you basically had the Great Depression of real estate prices. So how does that impact you when you look forward? What do you look at today and say, oh, wow, that reminds me of something?
Yeah, I think that's a great question. And certainly with that being my first cycle, being such a dramatic cycle, I'm sure colors the way I look at things, both the up and the down. And so I think looking at home price appreciation and affordability, there's different, and I know you look at that, but there's different ways to look at that is a great, if you just look at home prices, it looks a lot more problematic now, I think, than if you look at affordability, and affordability is actually still pretty good. It's worsening for sure.
Yeah.
That's a big piece for me that I look at. And then, I've been saturated with the distressed side of the market. And certainly here at Auction.com, what we're looking at is leading our marketplace, which is somewhat counter-cyclical, is seriously delinquent loans that feed into our marketplace. And then foreclosure starts, which would be notices of default, list pendants. And the foreclosure starts have been lower than they've ever been, right?
Yeah.
Seriously delinquent, it's a puzzling market. I'm sure you know this better than I do, but I'm sure every cycle is a little bit different, has its own personality, right? And this one is different in that we saw this huge spike in seriously delinquent loans, but those were caught up in all the programs, foreclosure prevention efforts that went into place because of the pandemic. So
right.
I would cite those as a couple key things that I'm looking at. There's several others too, but that affordability piece I think is really key.
I thought it was really interesting. You wrote an article about in January of 2020, talking about could we have a downturn basically in real estate without a recession?
Mm-hmm.
And actually, I thought that was a really good conclusion looking at the charts. So you were dead on. There were data that I looked at. Cal Poly Pomona has 1,000 homes appraised every 6 months, the same houses, for the last 40 years. And like 25% of those were negative 6 months from, say, July to January, July of 2019 to January of 2020. So that was the first sign that you had a softness in the market. Mm-hmm. And then, so that was a very reasonable conclusion to take a look at and go, okay, is this going to be, we have a great set of charts and we're acting like we've never acted before. We should be off to the races. And then the pandemic hits and all of a sudden, wow. So I'm just curious, what changed? What did the pandemic change to make real estate, I got to have it?
Yeah, I think that's interesting. And I do want to circle back. I'll answer that question, but I want to circle back. One other thing that was interesting in coming to auction.com, I got this new set of data that was our own proprietary data.
That's fun.
Nobody in the market has. And it's transactional data. I mean, at least pre-pandemic, we were selling 50 to 60,000 properties a year on our platform.
Wow.
It's gone down. And so there's a ton of, and we know, and it's a bidding situation. So we know what people are bidding, what the seller's reserve is, and that sort of thing. So you have all this kind of behavioral almost type of data. But one key piece, it's fairly straightforward, is the sales rate when a property goes to that foreclosure auction. The percentage of those properties that sell to real estate investors or other buyers, mostly real estate investors. And that sales rate, I actually found seemed to be some kind of a little bit of a leading indicator of the overall retail market, because investors are always looking 6 months ahead, or many times at least 6 months ahead. So we were seeing that sales rate dip leading into, and I think that might have been one of the metrics I cited in that article. I don't remember exactly, but that indicated that maybe investors had a little bit less confidence in the marketplace, and could be an indication of some softening. Now that leads into that other question you asked, which is what happened during the pandemic. And we saw that sales rate echoing a lot of other metrics in the larger marketplace, but our sales rate went from about 35 to 40%, averaging about 35 to 40% of properties that went to auction actually sold.
Okay.
It's now hovering at right around 60%, and has been, I was looking at this data just now, really since the beginning of 2021. It was going up there was a dip right after the pandemic hit, just, like a lot of charts you probably see related to the pandemic. But then investors quickly regained confidence and started buying more and more at the foreclosure auction. Now, part of that is also there was less and less inventory at the foreclosure auction to pick from.
Yeah.
So more of it, a higher percentage got picked up. But when I talk to our buyers, investors who are purchasing on the platform, there was definitely, in the first couple of months, there was uncertainty. And there was uncertainty around funding, around, the hard money that they're getting from sources
That's
like
right. Yeah.
P&G, and how, is that source of funding going to continue to be available to me? And what is the demand in the marketplace going to be? But it quickly rebounded on the part of investors as they realized that the pandemic had this, I think, surprising impact on people. And I actually just I'm going to steal a quote from an investor I talked to yesterday, who said a home became, I don't have the quote exactly, but a home became more important than ever. Yeah. Having a home and where you live became more important than ever, because you're spending, you're really spending the majority of your time at home. Yeah. It's not, in the past, it was probably split evenly, or maybe even you spent a little bit more time at work. And then all of a sudden, you're spending the majority of time at home. And so that I think sums it up pretty well, is that became more important to people in many different ways.
What was interesting, simultaneous to that demand going crazy, the other group of people that had their own houses listed pulled 45% of them off the market. So now you had all this demand landing on half of the houses. And it's really hard to find a place that has more than a month of inventory.
Right.
And so, the offers, you see, that what's interesting about what you said about the auction business, and I understand that almost that's 100% of the opinion that that's distressed sellers. But in this marketplace, I don't know that it wouldn't be the best place for a seller to sell a property, because it's exposed. How many clients do you have that are repetitive? A lot.
Yeah. You mean, are you talking about buyers?
Yeah, no, let's say I had a new track of homes. If I had a price in mind, I bet you if I auctioned them off at auction.com, they'd go for more. Just because you have a lot of people looking at it.
Yeah, I think that's right. Now we need to, and I love that because we'd love to expand the auctions where we may not be ready right away to do it, but we'd love to expand the auctions beyond the classic distressed property. But we've made one step in that direction we've started to do pre-foreclosure auctions. These are basically properties that the lenders come to us and say, this person is delinquent. We haven't foreclosed on them, but we actually think this is a short sale. And what we're finding is we put it on our platform. It's also listed on the MLS. About half the time we get a higher offer than the MLS. So
yeah, I think that,
but about half the time we're getting a higher offer, and the higher offers are actually an average of about 19% higher, $35,000 higher than the MLS. So that I think proves what your point. The only caveat I would say is our buyers are conditioned to buy distressed properties that are value add opportunities. So we'd have to,
yeah, you'd have to increase your clientele for another group.
That's right.
A retail group. Well, yeah. If you had the right inventory, they'd come and visit your site. It's kind of interesting. In other countries, auctions are how everything is sold in real estate. It's common. It's not a desperate situation. It's just the way it's done. But, in our country, definitely you always think of auction. Oh, poor seller's got some problem.
Right.
Sometimes they just want a bigger audience because you guys have had, years in producing a lot of audience. What's interesting about auction.com? The way that company started was auctioning off a friend of mine's tract at the beginning of the crash.
Really?
Yeah.
Okay.
And to have that grow to this size of a business when there was established auction companies for a long time, that's actually an amazing accomplishment to me.
Yeah, and I can't claim to be a part of those early years. But yeah, I'm impressed with the growth that this company is seeing. And really I think the attitude is about trying to make the auction platform as transparent as possible so that you do achieve that, that highest and best offer for the property. And that's been, and I would say a really big, early on it was REO, the focus was REO properties, bank-owned properties.
Right.
And that was big, especially during the last crisis. But the shift also became, one of our keys to growth came when we started auctioning at the foreclosure auction.
Absolutely. You dominated that really quickly.
Yeah. And treating that, because banks in the past really treated that as just a hoop they had to jump through to get to REO.
That's right.
Yeah, I mean, the state statute requires you have to put it up for auction at the courthouse steps. And auction.com said, why don't you use that as an opportunity to actually sell the property if you can? So, yeah. And we still, even with all that, only, like I said earlier, 30 to 40%, 35 to 40% pre-pandemic of those properties were selling. But if you go back before auction.com, it was more like 15 to 20%. So that would sell.
How big is, when did the shift go from we're going to do a live auction to we do it online?
Well, we're still working on that. I mean, the REO auctions are all online because there's no physical requirement, but the foreclosure auctions in non-judicial states like California, it's a little bit easier to move that online. But there's still a physical auction that has to take place. And so it requires actually the changing of a state statute to do that. And Ohio is one state and actually Florida, where you are.
Yeah.
So those are the two states that allow the foreclosure auctions to take place online.
Okay.
And we see, when we look at our data, we see that's actually in general produces better results because you get a wider audience,
Sure.
bigger audience for the properties. It's not whoever can just show up at the courthouse steps at a certain date and time. But I mean, it's still constrained by date and time, but at least you can be doing it from anywhere that you have an internet connection.
I would think it would expand your buyer pool by a lot.
It does, yeah. Yeah, I've been recently looking at some of the data in Ohio, and we see, because some of the auctions in Ohio are in person, handled by the sheriff, and some are online, and so we can compare those two, and we see the metrics, the sales rate, the price to value that we get for the properties is definitely higher with the online auctions. And one thing, not to pitch like Auction.com's product, but it does tie into your question, is that one way we're kind of getting around that in states that don't have the statute changed is we do have something called remote bid. So if you get the Auction.com mobile app, you can participate in, at least in some states and some counties, and California is one of these, you can participate in the auction on your phone.
Okay.
So we're at the auction, crying the auction, Auction.com is, and through our mobile app, if someone places a bid, that bid is coming in, and we're entering that bid into the auction process. So that's a step in that direction as well, toward removing some of that friction and increasing the pool of buyers that we have at the foreclosure auction.
Are your auctions always seller reserve, or are there ever any absolute auctions?
As far as I know, they're all seller reserve. The REO auctions, there's always that seller reserve in place. I actually could be wrong on that, but there may be some exceptions there where the seller is just ready to get rid of the property.
Probably rare. It's probably the exception, not the norm. Okay.
Now the reserve, can be, somewhat flexible, for lack of a better word, I guess, where the
seller can make a final decision.
Yep. They say, well, this is the highest. We put it up for auction. We got a bunch of bids. The market is telling us this property is worth X, even though our reserve is a little bit higher than that. We'll go ahead and take that X. With the foreclosure auctions, the reserve automatically is the amount owed on the loan, and they can't set the reserve higher than that.
Correct.
So if it's a property that's worth $100,000 or $500,000, the loan is $400,000. Their maximum reserve on those foreclosure auctions in that case would be the $400,000.
Correct.
And so and now if it goes above that, which it might in that situation, then the remaining amount would potentially be surplus funds that would go back to the distressed homeowner. Correct.
I had never seen a chart that you have at your LinkedIn site, and it was pretty cool to see. And I was actually disappointed I had never seen it before, but I'm happy I saw it today. It was the vacancy chart. The number of vacant homes was once like way more, and now it's like the other end of the spectrum. There's a lot less.
Yeah, I think hopefully I gave credit, but I shared that from someone else who was sharing that, I believe. I think it was the chief economist at Freddie Mac.
I think you might be right.
Lynn Kiefer, yeah. So, and I found that very interesting that, if you look at the average vacancy rate over time,
is that a vacancy rate? Excuse me. Is that a vacancy rate or vacant homes? Because that's sort of it's kind of a different, to me, it's different. It's
the percentage I think it was a percentage of homes that were vacant, but
yes, that's correct.
And so sorry, not vacancy rate in that sense, but Yeah, I mean, if you look at that kind of average percentage and what we are at now, and then extrapolate how many, basically the undersupply of homes
Yeah,
for sale and for rent, I believe the number is, based on their calculations, was about 1.9 million undersupply versus the opposite end of the spectrum back during the last housing boom.
yeah. Joey, let me just add one other thing,
Yeah.
because it's kind of the same subject. Over the last, and I'm going to forget the exact years, but I think it's the last 8 years, there were about 12 million households created, but there were only 7.5 million new homes built. So both of those trends lead to a housing shortage that I don't know how long that takes. I've never really dealt with, okay, well, how do you go and reverse that? Because that doesn't seem like that's going to take months.
Right. Yeah.
Joey, go ahead.
Yeah, go ahead.
Daren, are you guys nationwide?
Yes. Yep.
Okay,
Absolutely.
so then I have a question, two parts. Where's the bulk of your inventory coming from? And does state legislature have anything to do with that? In other words, is it, states like California where it's harder to get people out of their homes, keeping the inventory low for you guys? Like, how does that work for you?
Yeah, I mean, our inventory is nationwide, and it kind of aligns with the size of the states, honestly. But leading into the pandemic, and it's still true, a lot of our inventory was disproportionately in the northeast of the country. Places like New York and New Jersey would stand out, because what we were seeing there is still the long tail of inventory left over from the last housing crisis coming through. Even through 2019, we were seeing this. And I think we'll see this even pick back up potentially after now that some of the foreclosure moratorium are lifted. But yeah, in the Northeast, which, you think California is tough. New York and New Jersey were really tough in terms of foreclosing, and we saw extremely long foreclosure timelines in those states. And so that's actually where we had been seeing the most inventory. I was just looking here, kind of as we're starting to see the foreclosure volume return, which we slowly are seeing that now in the last couple of quarters, really in the fourth quarter. The places where the way that we look at it is percentage of pre-pandemic volume that we're seeing come back. And the places that are returning the fastest are the places where the foreclosure tend to be the places where the foreclosure process is the fastest as well, and the easiest in a sense. And so you see places like Oklahoma is actually at 108% of its pre-pandemic levels in terms of foreclosure volume. Indiana is at 86%. Let's see, those are the two ones that stand out that are high volume and also high percentage. California actually is at 50% of its pre-pandemic volume as of the fourth quarter. I was actually surprised that we're seeing volume come back in California faster than some other states. If we look at New York, it's it's only at 17% of its pre-pandemic volume, and New Jersey is at 18%. So those states, again, similar to the last go around. And again, I don't want to, well, not again, but I don't want to compare this to the last recession and saying it's the same, but the states where that foreclosure process is the most restrictive is where we're seeing the foreclosure volume now post-moratorium return the slowest.
When we talk about 2020, though, when you look at a foreclosure chart now go backwards, 2020 is probably 5% of the peak before, right? As far as the number of foreclosures in 2020, there almost aren't any when you look at a chart.
Yeah.
So having a 50% increase over almost nothing it sounds.
Well, it's not a 50% increase. It's 50%. So we looked at the fourth quarter of 2021 compared to actually the third quarter of 2019, and we're at 50 in California. We're at 50% of the third quarter 2019 levels. But to your point, even in 2019, we were seeing very low foreclosure volume. So if you take that as a percentage of, say, 2009 levels, it would likely be, I would guess under 20%.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.